So for Forex in 5 this week, as we look towards developed markets, we discussed previously around which G3 nations or beyond had done too much in terms of keeping their rates high for longer and there being a negative impact on inflation. Now, we've seen inflation dropping in the US, UK, Europe, but there was a bit of a spanner in the works when it came to US inflation last week. We saw a bit of a surprise, bit of an uptick in inflation, about 20, 30 basis points above expectations. This has caused food for thought amongst G3 players, as suddenly it seems that maybe the US are on the right path. Cuts are still priced in, cuts are still going to be coming, but they may not be as urgent as once expected. Now, when inflation print does not predict the full trend, we could see still a bigger drop off in inflation. But for those such as us who are looking for a much more sizable drop into 2024, this has given a more tempered inflation path as it starts to move downwards. Europe, on the other hand, are trying to hold fast. They're trying to keep their rates where they are. We've seen the market pricing in more cuts than what the ECB are currently giving in their commentary to the market and the press. So at some point, something's got to give there. Likely it will be data that dictates what happens. But someone's got something wrong. Either the ECB are going to have to start walking back their comments and be a bit more dovish, or we'll start to see the market start pricing in less cuts through 2024. In the UK, it's very much the same story. It's a bit of a sideline. Everyone's watching the US more as a sort of canary down the mine, given that they are, in theory, a bit closer to that sort of soft landing that they're looking for. We'll start to see what happens in the UK. Obviously, mortgage rates have been cut quite a lot recently, which has buoyed sentiment in the UK, but there's a lot more work to do. There's no doubt about that. So we'll be watching Governor Bailey and future comments in the coming months to try and get a feel for where cable is going to settle, and obviously also the euro and the dollar in general against other G10 currencies. So over in emerging markets in the frontier, obviously our big focus as always is Nigeria. Now we're entering quite an interesting time. The parallel rate has gone above 1300, so that sort of matches the highs that we saw in October, November. However, 2-3 months ago we saw a bit of a panic spike up to 1300 and then a quick pullback below 1000. This time round, we've just sort of steadily ground over the last 3 months up to these highs. So the question is like, what's going on here? Now, if you look into the macroeconomic standpoint, inflation data released last week and also money supply data this week in particular paints a pretty grim picture in terms of inflation sort of coming way above estimate. Similarly, like increased money supply in the market. So this would dictate a depreciating currency. However, it should be noted those money supply figures don't quite capture the last couple of months where we've seen the CBN conducting their open market operations, so CBN issued bonds that we've been calling for some time. We've seen quite a few auctions happen this month in particular, but also in November last year. So as those auctions filter into the money supply data, we may see some positivity come back. However, fundamentally, the rate doesn't seem to be stopping. I mean, a lot of local corporates are nervous to buy dollars at these levels, knowing that a pullback could happen overnight. We know that the CBN and government, they're sat on dollars, allegedly from the AfriXM bank disbursement. They could put this straight into local banking institutions to clear out some of the FX obligations that are currently outstanding, and that for sure would give a pullback in the rate. But if nothing changes from an economic standpoint, we see the rate potentially grinding higher. So it's a delicate time at the moment in Nigeria. Over in Kenya, it's similar to Nigeria. We've seen quite a lot of depreciation. The rate has gone straight through 160 and doesn't seem to be stopping at the moment. You look at, say, the euro bonds no longer being paid back earlier, which a lot of people consider to be effectively like a debt restructuring. Rating agencies such as Moody's will clearly take this positively because they were looking to downgrade on any sort of debt restructuring. However, with monetary policy seeming to be a little bit ineffective, like the last round of rate hikes from Governor Thurgood and the MPC doesn't seem to have had the desired effect. We've seen rumours around like sustainability debt swaps. I mean, there's more that's going to need to be done to control where the Kenyan shilling is going to go. We know that the CBK and the government feel that the Kenyan shilling is undervalued, but at the moment, the rate at which it's depreciating, it's the rate we trade today, is no longer valid like 2 days later, 1 day later, even 6 hours later. So there needs to be a bit more work from the CBK in order to control the depreciation in Kenya. Finally, in Tanzania, an interesting one. We've seen some weakness in the Tanzanian shilling. It's over the last 3 weeks, we've seen a breakthrough 2,700 on the parallel. Banks seem to be offering out dollars at much more favorable rates. It was at 25.50. They're now offering sort of through 2,600. However, inflation, where in Tanzania inflation is quite low relative to neighbouring territories, inflation data paints quite a positive picture. Actually, it came a lot lower than expected. So you would think that would cause some strength in Tanzanian shilling. However, we seem to have seen the opposite, and this seems to be just simply from the supply of dollars that are coming in. But we expect Tanzania to probably stabilise a lot earlier than the likes of Kenya and Nigeria. Also, just a quick note on the Central African franc. It's an interesting dynamic at the moment because we've seen the sort of spread between ZAF and ZOF change ever so slightly. ZOF seemed to get a bit of strength sort of about a month ago, with it dropping well below 700 against the euro. However, that's pared back a little bit, but it seems that the spread's a little bit wider than what we had seen towards the back end of last year. So it's yet to be seen whether that will persist. As you know, as a peg currency, it's a bit different to the likes of Nigerian naira and Kenyan Tanzanian shilling, but we'll be keeping an eye on the spreads there in due course, especially over the next couple of months.